We are more in the 5 to 10, 5 to 12. But the mindset problem, I see so many people go in, split the pie instead of defining all the knobs we can turn and then make it more valuable so there is more pie to split. You have to show that you're credible to a broker. You have to show that you come from...
If you're not making the money you want to make, it just means you're not shaking enough hands and you don't know enough people, and enough people don't know who you are.
If you know if you're a visionary and integrator, if you have your core value set and you understand your personality, your strength, dump all of that into AI.
What's going on, everybody? Welcome to another episode of the Commercial Real Estate Blueprint podcast. I'm really excited for today's episode. We have Andreas Pettersson. Me and him connected, probably about a year ago regarding some multifamily real estate. He was looking at the time. He was in the corporate world, in the corporate grind, and he recently escaped that. And now he is focused on capital raising, and he's a commercial real estate enthusiast. So he's got a ton of value to bring. I'm really excited about this podcast. Thank you so much for coming on, Andres.
Thank you so much for having me. I love this topic. I can talk about it any day. The risk it will be for you to stop me talking. Me all the time. So
no, yeah, for sure. Before we got you on here, I told Jesse, I was like, yeah, he's going to be a great guest because, I follow you on social media and stuff. And I think when we met you first, you were just starting into posting, like literally you had just started. And from the content you're posting, I was, wow, this is valuable information. So we got to get him on the podcast, and here we are.
I love it. And for years, I wanted to get in and do something on social media. But when you are a corporate CEO and you have a whole PR team that keeps telling me, don't do anything. And I was working in the security industry, cyber security, physical security, and even more, don't talk about it. But last year, something like, no, I got to share my experiences. I got to tell the world what I'm doing. I enjoy doing it. I screwed up so much with social media in the beginning. Now it just comes natural for me. And the amount of people reaching out and saying, hey, you said this in a video, I applied it in my company, it really helped me, or you made me aware of this and that topic. It's pretty cool. So I just never will figure out the algorithm. Like some days I post something and it has no views, and some days it can have thousands of views. I will never understand how the algorithm work, and I've stopped trying.
Yeah, it's a tough game for anybody who's trying it. It's a tough game. But for people who don't really know you, walk us through that transition and give us a little of your backstory, the transition from the corporate world into where you're at now and kind of how you got into real estate.
I've been in the corporate world for a long time, since 2007. Originally, I'm a software engineer. I climbed from the bottom to the top, the corporate side. I was an executive for a decade, CEO for 7 years, started a company as part of an incubation and ventures team, grew that, had a 9-figure valuation merger, and exited out of it 1st of November. I didn't get paid on that, but that's a different story. I wish I did. But I still grew it. We were about 150 people. I loved what I was doing, but at the same time, I really felt done with what I was doing. And just before we started here, I showed you a graph of the amount of arrhythmia I have on my heart. And from the day I left, it's just been going down, even if I put in more hours. The story of how I got into real estate was actually moving to US. So when we moved to US 2014, we started renting out our house in Sweden. And we realized that the passive income game is the game. That was very passive and very good returns. But then I have a son that has autism, and my biggest fear in life was actually to have my autistic son's 2 other brothers having to take care of him. And we were looking for a passive income way. So because my autistic son, he's an amazing human, but he might never have a job that pays him what he needs to be paid for. And I don't want his brothers to have that worry in their life. So we looked at a lot of different things, but the one we could sort of figure out to the amount of effort to reward and the amount of, you can delegate real estate portfolios to a lot of other people. Even if you pay them a lot of money, it's still enough to give my son a good life when he is an adult. And should something happen to me and my wife, he's set up. So that's how I got into real estate after looking at so many different options. And we started with single family, then we started buying multifamily. And then when you and I got connected, that's when I started the real estate fund to really accelerate things. But the market 24 wasn't that great for multifamily. So now I'm doing RV parks.
Yeah, that's so cool.
what a noble way to, want to get into real estate and take that action. It's such a good motivation. It's very commendable that that's the reason that you're doing everything. They get so many people in the real estate world. It's like, it's so superficial, and then their motivations, and then, what they put out, content and stuff. And it sounds like you're putting out lots of really great value for people that are starting in commercial real estate, have their own business. That's stuff that I love to talk about too. But talk to us about, that a little bit more about that multifamily to the RV park jump. What made 2024 so bad, and what made you want to leave multifamily altogether?
Yeah, so I still have a multifamily portfolio. We have both single and multifamily in Long Beach. I don't want to say I'm a slumlord, but it's not the best part of town either. They're cash flowing, which is rare for California. What made me look at scaling it up were you need a lot of capital to grow a portfolio in California. And I mean, just a small we have one, or it's a larger 8-plex building, actually. It's a 3-bedroom, 2-bath. Just that building was 3.2 when we bought it. And then with remodeling and everything, it's valued at 4 or above. But the point is, we had to put not only 30% down, but we had to remodel with another 10-15% on top of that. So it's so much cash you tie up. And sure, it's an appreciation game, still cash flows, but the amount of cash flow I could get in other states is so much better. So in 23, I really thought, okay, I'm good at building businesses. I have a lot of people in my network with a lot of money, and a lot of people who were interested in what I was doing. And many of them have had successful exits. So I decided, okay, I'm going to go build a real estate multifamily investment fund, and then raise capital blind. And raising capital was actually not the hard part. I saw you, Graham. I was in North Carolina. I'm just blanking on the city.
Raleigh, Durham area.
Thank you, Raleigh, Durham.
Yep.
I was there, and we were looking at North, South Carolina, Georgia, and we were probably underwriting last year north of 200 deals. In the end of the day, if you want to make a portfolio grow really fast, you need 2 things. You need money, and you need really good unicorn deals. And if you have those, you can grow a portfolio very quickly. It doesn't matter what you do, really. Then keep underwriting deal after deal after deal. And the IRR or the cash on cash is like 5%. Or it's better to put your money in S&P 500. And there are people out there that are finding deals. I'm not saying that. I didn't crack the code on it. Every now and then we found something that was decent. We put out a lot of offers. And that's the one recommendation I screwed this up early on. I was not putting out enough offers in the beginning of the year. And even though not all real estate agents like this, but spam out the offers, because sooner or later, that's your backup offer. Even if you don't win the bid, that's a backup offer. But anyway, I'm going long here. But the point was, we were really struggling to build that portfolio. We were struggling to get the deals. I had the money lined up, and I had to actually back off investors that I got all excited. And then we got in, but then I realized that RV is a new space. But maybe you have some questions about the first part.
Yeah, no, I think that's a great point. I mean, I'm not sure if I told you this yet, but I've kind of transitioned out of multifamily brokerage, focusing more on industrial brokerage now, because that's what our firm buys. But I was doing multifamily brokerage back when we met, and it was challenging, combined with interest rates and the fact that sellers were not adjusting their pricing for those interest rates. And it was just so freaking competitive. I mean, I think the natural progression for a lot of residential people is to go into the multifamily space, because it's still technically residential, it's just more units. And so I feel like multifamily is probably the most competitive. I don't know if that's statistically accurate, but if I had to guess, multifamily is probably the most competitive asset class to be in commercial real estate. Plus, it's kind of just a pain in the butt. So, I mean, I don't think it was just you who's having difficulty. Everybody was having difficulty. We didn't close many deals in that period of time, especially in, the category that you guys were looking, which I remember right, was probably like 25 to 100 units. And that's like uber competitive. So yeah. I definitely don't think that was just you. And then the other thing, I tell my clients that all the time. They're like, oh, well, the number doesn't make sense. I was like, send them an offer anyways. Send them an offer where the number makes sense for you. Like, don't just send an offer, but if you like the deal, then send an offer where it makes sense for you if you actually like the asset, because you never know when they'll say yes. Because I've seen it time and time again where they're, it's like $1 million deal and you offer 600 and they're like, well, maybe I'll do 7. And it's like, oh, I didn't think they would come off that much. So I think that's a great point.
No, and it doesn't matter if it's multifamily, whatever it is, just get the conversation going. The second advice I would give is work with an amazing broker. There are so many freaking idiots out there. We keep sending offers. They never reply. And that's okay. They get a lot of trash. But if I'm really serious and I'm actually putting an offer out there that is within striking distance, you want to follow up with me. And so a lot of arrogance. And the thing we started doing, which actually in RV parks, it works even better, is no offense. We bypass some of the brokers. We figured out who owned the building. We started a conversation with several of them before we pivoted to RV parks. And then we brought the broker back in. And by doing that, we actually then the conversation is at least happening compared to it's just a wall of silence. And I know I won't have all the supporters listening to this or you guys supporting that, but bypassing the broker sometimes makes things start to move.
Yeah, I can see why that's a thing because, we deal with brokers also being brokers and we deal, if we're representing a buyer, we deal with sellers brokers. And you're right. Sometimes you'll inquire about a building. They won't respond. You'll inquire again. They won't respond. You'll send an offer. They won't respond. It's like, do these people want to make any money or what? I'm kind of confused. So I agree 100% that you have to find a good broker, somebody who actually, bridge the gap in the conversation and actually put things in front of people.
You always came back to me and you always followed up. So you're one of the good guys. And I'm not just saying that because I'm here, but I'm saying that's an exception, not the rule.
I appreciate that.
So anyway, continue the stories unless you had another question there.
No, well, I was just going to make it the point of I think a lot of times you talk to brokers and it's like, well, I haven't had a conversation. I don't think you would sell. And they're assuming they don't know. They haven't talked to them. They're just trying to push you off because they don't want to deal with you. And I don't know, you would make more money selling it. I don't know why you're trying to push me off, but that's the impression that I've gotten from a lot of brokers.
I'm with you.
Yeah.
And also they are prioritizing the biggest deals. That's just the way it is. Where the coin operated, where the money is, that's where the broker will go.
Yeah, for sure. So talk to us about why you picked RV parks. You made the transition from multifamily being difficult to RV parks.
Many reasons. First of all, it's who you do things. At my stage of life, career, everything I've done is rather who I do it with rather than what I do, actually. RV parks they're very interesting because many of them are owned by boomers that are getting ready to retire. Many of them have either built them as the last they build an RV park that was their retirement plan. And then they realized, shit, this is a business by itself. I cannot operate. I haven't never run a business at this scale. And they realized that a lot of things with RV parks is actually marketing, sales, and customer experience. And that's not their forte. What we started doing is we started doing outreach directly to the park owners. We befriend them or we get to understand what their main problem is. And a lot of the boomers, they do not want to pay taxes. They do not want to have an exit. And they may be like, oh, is the park really worth that much? So what we talk to them is about creative financing, seller financing, or taking on, if there's debt on it, subtuing that debt into something else. But obviously we want to give them, if they want a specific price, the terms just have to be amazing. I also believe at this stage of the game, there's enough opportunity out there. I don't want to say exactly what our buy box is, but we are keeping to the smaller ones. So we're staying below the radar of institutional money. We're leveraging our expertise, our combined group, the fund I run, Leapfrog Funds, we JV with another fund called Venture Vibes. And they are, by the way, just quick tangent, they're so committed. They have done real estate. They have good money. They have good W-2 works. They decided almost a year ago to go live in RV parks just to truly understand the business, even if they have primary residents that are really nice already.
Wow, that's awesome.
That's dedication.
That is dedication. But so we partnered up with them because they're very good at operating, customer experience, and all of that. I'm good at cap raising, marketing, business strategies, and just management in general. And what ended up happening here is we thought it's only going to be we'll maybe take down a couple of parks and so on. But all of a sudden, we found ourselves in an interesting spot where we are past due diligence on escrow in one. We have a signed LOI for the second one. And then we have a verbal approval for the third one. We're sending in offers for the fourth and the fifth park. And these are all really good returns, or at least in my eyes, they're really good returns. The one I'm raising capital for right now, we're almost done raising for that one. It's a smaller park. Can I say numbers here? I don't know.
Absolutely. Yeah, absolutely.
I don't want someone auditing me after. So I'm going to be politically correct. And I'm going to say average returns our park so far and what our strike price is, we're looking at closer to 30 IRR. We're looking to at least 15 to almost 20 cash on cash and a 2.5 to 3x multiple. That's what we are seeing in these parks we're getting under contract. That's an average return, no guarantees, no promises, disclaimer made. Someone kicked my ass for saying, we have this park under contract right now. We're raising X. Here are the projected returns. And I put that out on social media. And instantly I had a lawyer friend who's like, you don't want to do that. Trust me, there isn't enough disclaimers on that one. Okay. So I took it down. So that's why I'm being extra careful.
Yeah.
But that's how we got into it. And I think many people that are coming into commercial real estate, they think organic growth. They don't think scalability. But if you want economy of scale, you can't go in and half-ass it with 1 or 2 parks. You got to think portfolio. You got to think of synergies in marketing, synergies in management, synergies in how you operating like the investor relationships, all of those things. And I think it's the wrong approach to go in like, I found this one building or this one asset and I really want to get it. And they get fixated and stuck on that instead of thinking, no, I'm going to build a portfolio and then I'm going to go find things that fits into my portfolio and I'm going to line them up one after another. Because when you're raising capital, you don't want to go hot, cold with your investors. You're always raising capital. But the only way you can do that is you always have a deal for them.
Yeah.
I'm going down in so many different directions.
No, it's okay. I have a quick question for the people listening, because I actually don't know. What is technically, like, what level and size units would an institutional group be looking at? And then like what size are you targeting? Because you mentioned like you guys are going for small ones, but I don't know what theoretically on, what do you consider a small park and what would investors look at, or institutional level investors be looking at as well?
What we have noticed is that institutions are looking at $15 to $20 million parks. We are more in the 5 to 10, 5 to 12. And the reason why the first one we're doing now with this JV, that one is even lower than that, but it's such a freaking good deal that we couldn't stay away from it. But normally we underwrite the other ones we have now in the portfolio. They are a little larger. They're typically 50 to 150 pads, RV pads. If you go above 200, 250, you need a whole different management structure. You need a second on-site RV camp manager. You need a maintenance crew at a different level. And then we are staying the hell away from when there are multiple businesses on the RV park. So let's say that you have a massive restaurant there and it's full menu because it's next to a lake. Like, we're not interested in that. We are very much, we want to buy parks that we can operate in a very cash efficient way, where I can use my technology background and software background to automate a lot of the processes and procedures. And then I have a long marketing background. So we're also looking at sort of building the whole portfolio and marketing and preparing our portfolio for institution to buy them. But if you want to compete with institution, I mean, we're talking, you have to go look for checks that are $5 to $10 million. Here, I can go look for smaller checks combined with a couple of big checks, and I'm not competing with the institution. They don't care about this, like sub 150, sub 200 pads, they're less interested.
That's cool. Yeah. I didn't know. In my mind, small was like 5 units, 10 units. So
so in RV pads, what is it really? It's either concrete or gravel that just happened to be flattened a little bit, and you have sewer and water hookup and electricity, and like that's it. Several of these parks we're finding, and I may be giving away too much, but hey, the market is big enough. There's a lot of parks that were built in the last 2 to 3 years, like I said, by boomers that want out, and they don't want to be hit by big taxes. They're open to seller financing. The biggest crook in getting that deal to happen is the broker who don't understand seller financing, who just want the cash right now, and they actually screw it up for the boomer, and now they're hit with a tax return, or they have to pay extra tax money, and now they destroyed their pension plan. Instead, I think that if a lot of brokers educated themselves on what is it that I'm making this seller, what is that they truly want, like what's their pain point? Their pain point is they want to live off of this money for 10 years. They rather see money come in every single month, a guaranteed check, and now they're happy.
Yeah, I think that's important. And what you got to be careful of when you're sending out a bunch of offers is try to build a relationship a little bit first. You don't want to be like, hey, I want to buy your park. I want to offer you 1.1. And they might have been being like 3.1, now you've pissed them off and they don't want to talk to you ever again. And you can't figure out what that pain point is to find out if seller financing is a good thing for them. So it's very, you got to be careful when you're just throwing out offers. And I'm glad you brought that back up, because it was something I wanted to circle back to when you were saying earlier. We talked to this guy, we figured out what his pain point was, but no, I'm glad you brought that back up.
Yeah, and the thing about brokers screwing up deals with seller financing, like I said, we also deal with brokers. I cannot stand when we submit a seller financing offer and you ask them a simple question or ask them to, like, if they understand it and they just don't understand. Like, I'd say probably 9 out of 10 brokers don't even know what's like how seller financing works at all. And it's like, if you don't know how seller financing works, you probably should not be a broker, especially over the last 4 years.
Yeah.
Because the last 4 years we actually used seller financing. Prior to that, we didn't do it because the market was so hot that no seller would agree to it. But I just had something pop in my head. I'd be curious to hear this for me and Jesse's sake, and also the people listening who want to go out and buy a deal. We talk a lot about seller financing. The two of the deals we just bought last quarter were seller financing deals, and there's so many beneficial reasons for it. But what's your pitch to sellers on why they should do seller financing when you reach out to them?
No,
like,
and
what do you
and I
guys
think
say?
we're all maybe active here in Sub 2 as well, in Pace Morby, and several of the people, I saw the little piece like came up there.
Yeah, I did.
But it's amazing. That branding, like, he have done a phenomenal job. As soon as someone do this, I think of Pace Morby now. It's crazy. But anyway, the pitch is guaranteed. Like, you get a price that you want. I'm not going to push you on the price. We agree on the price. You get the price you want, and let's focus on terms. And as soon as you get, like, that's what they want to hear, because they build up, they put the sweat equity into it. They worked hard. They have been done everything to get the price they want. Maybe a broker promised them a price. They were in the market at a higher price. They couldn't get that. So now they feel a little beaten up or negative about that. I'm like, no, we'll get you the price you want, but you have to work with us on terms. And you know this, like, if the price is wrong, the terms have to be right, and opposite is also true. Yeah. So in our case, we end up hearing them out, like, what's their pain point? Do they want to retire? Do they want to? How much cash do they need to buy their next home? Where are they moving somewhere? Do they have dreams for buying that car they always wanted? Or, like, we get very curious with the seller on what's their dreams, what is their sort of must, should, could list, and then instead of splitting the pie, and I think people make this mistake all the time, they go like, let's define the size of the pie. And the pie is X. And now it's a negotiation of just taking the biggest piece. What we try to do is make the pie bigger. And the park we're buying right now is a great example of this. And by the way, the seller, very sharp business person, very open for anything creative, as long as he gets the price he wants. And I don't want to disclose numbers here because we haven't closed on escrow yet. We're past due diligence. And the thing is, instead of splitting the pie, he goes, you guys are looking at adding 25 extra pads to this 54 pads already here. I'm like, yeah, that's part of how we get investors. He goes, I'm actually owner of a construction company as well. I'm not as active. What if I helped you build that? And you get a price that is better than you will find from someone else, but I still make some extra money on this. And now in my transition out of the park, I actually have an additional income coming in as I'm sort of working on finding my next property. I'm like, absolutely, like, let's go. Then also we had several conversations about how the seller financing should be structured. And it wasn't until we understood his retirement plan, what it is that he likes to do, where we could structure it in a way that was a win-win. Win for him, win for us, and actually a win for our investors as well. So I think getting curious and not just jumping in to sending an LOI. My comment before about sending an LOI, we still do a lot of the discovery, but I do think that I see so many people, what I was trying to push on earlier in the talk here is I see so many people who keep analyzing deals and never send LOIs. And that's not a good approach either. But it's like you can't just spam out them either. No, so that's that. Did I answer your question?
Yeah. Definitely. I think that's great. And I think it's huge to touch on like the seller's motivation and the price too. Maybe just for people listening, because, like you said, we've heard Pace Morby talk a lot about price and terms, but for the people listening, elaborate maybe a little bit more on what you mean when you say terms have to be really good.
If the seller wants a specific price that I deem is $200K over market on a $2.5 million deal or whatever. Like, it doesn't matter. So just you get, let's say it's 10% over what I underwrote it to be worth at best with the cap rates and all of those things. I have to find 200K somewhere else. And what many people make the mistake of is they get blind on the price. If you can come up with terms, like I said, good construction still benefits him. If we can come up with terms where, okay, maybe the person doesn't need as big of a down payment, but he still want to stick to the price and he needs his money over 10 years. This is not a real deal, by the way. We have been able to find agreements where, let's say it becomes completely seller financing on existing debt. We take that over sub 2, or we take over the existing debt sub 2. The extra debt is seller financed. We don't need a bank at all. So now the terms are becoming really good. We don't have to go through the bank process. We still have to raise capital. We do improvements of the building that the seller deem as not as too much work to do, or the asset. If there isn't enough room over, let's say, a 10 years time frame to do interest and principal, maybe we'll do a few years interest only. We do a few years principal and interest and so on. So like, that's what I mean with terms. Every knob you can think of turning, but the mindset problem, I see so many people go in, and this is in business in general, it's split the pie instead of defining all the knobs we can turn and then make it more valuable so there is more pie to split. Keep just building and adding, like, oh, that tractor over there, are you keeping that? No, we can include it in the deal, but then I would like to see this and this and return instead. I'm like, okay, that's cool. We actually need a tractor. However, we don't need that big one over there. You can take that one. It's like, oh, I thought we were including that. Then we can knock off 20K on the price and so on. So it's that constant, what are the knobs? Define all the knobs, get curious on the seller, which knobs he likes to turn, and then start tweaking them back and forth together. That was a long definition of terms.
Yeah, I think that's such a great point. Like, a lot of people will look at a deal and they just think the building and that's it. They don't think about all the different knobs, like you said. Like, when I first joined, like, started doing commercial brokerage and stuff with Graham, he's like, pretty much everything is negotiable. And I was like, oh, the whole book, the whole playbook is open. Like, I didn't even think about, like, there's just so many different ways you can include different things, and you can't limit yourself, like you said, with business too. I'm curious how you guys look at marketing and outreach, how you're finding these deals. What else are you using to find these deals?
I'll reveal most of them, and I keep a few secret sauces for myself.
Of course.
I think there is a lot of wrong listings, especially with RV parks, because people don't know if it's a resort, if it's a real estate, if it's a business. So they end up getting listed wrong a lot of times. You have to crawl through the different sites to find them. We have met a lot or seen a lot of deals that are listed as business for sale, when in reality it is an RV park and most of the income is technically from housing RVs there. But they list it like that because maybe they have a lazy river floating business where they bus people up the river and let them float down. Maybe they have a massive restaurant that brings in most of the revenue. Maybe they have horseback riding on the property. So they list them as businesses, and the seller is so stuck on that it is a business because it's their passion project. If you're into horses, you're into horses. You are running a horse camp or whatever it's called. And that's just how your brain is stuck. And that's okay. So then learn to speak the language of the seller and how they would like to be talked to. So wrong listings. Right now, Pace have set a whole army of RV people out there. Some of them have good deals. Some of them are overpricing their deals that are publicly available. And I'm laughing at some of the wholesalers selling me some deals that I can go look online and just go directly myself. But I would say definitely network. Go into your communities, network with up and coming people who want to break into the space. Sooner or later, they find gold. And I can tell you, we found a few people that bird dog. Go find the deals for us. That has been very beneficial. How they find them? I mean, in the end of the day, like you talked about, you have to befriend the seller if you go direct. You have to show that you're credible to a broker. You have to show that you have a brand, you come from, you have access to capital, you have run other businesses for the broker to take you serious. You can't just pick up the phone and say, I have a fund, give me your deal. No, they will background check you. So now I'm not really answering the question, but I do want to say it's so freaking important. If you are talking to brokers, have an updated LinkedIn page, have a clear business card, and have a website, because otherwise they don't call you back.
I think touching on what you just said, going back to the multifamily example, like for the last 4 years when I was doing multifamily stuff, I would get a call a day from somebody at a New York or California, no offense to the Californians, saying we want to buy multifamily properties in North Carolina or South Carolina. What you have to do is like you build relationships with the seller, but also you can build relationships with brokers. What you did stood out tremendously. You actually flew into Raleigh, you came into our office, you sat down with me, and we talked about deals and stuff, and I felt like I got to know you. And so then what happened? I started sending you deals. And I feel like that's a playbook for what you should do with brokers, because I'm far more likely to send somebody a deal if I've met them in person, like them, and know who they are, rather than somebody just call me up or even worse, most of the time people don't even call. They just send an email. Hey, here's my 1-page criteria for what we're looking for. And then they follow up with you like once a month. You got anything new? You got anything new? You just forget about those people.
To Graham's point, like what he always taught me was if you get the person, whether it's the seller or if you're trying to, anything you're doing in real estate, if you get them in front of you, the chances of that deal going through goes up like astronomically. So you got to get in front of that person, whether it's direct seller or broker or whoever you're talking to.
Yeah, 100%.
1000%. And it's the same in any type of business. I'm tired of, in the end of the day, you do business with the people you have relationships with. When I showed up in your office, like, yeah, I said what I was looking for, but that was not the main, like I got curious. I was super curious. I shared sort of my reflections of the other people I've been talking to. Just be open and curious, and then show why you like something, why you like an asset, why you like an area. And it's universal, and be honest, like it is what it is. But here's the thing. If you haven't put your LinkedIn, you don't have your branding, you don't have your card, and you didn't show up, then you put an offer out. What's the first thing the broker is going to do? He's going to present the offer to the seller. What is the seller doing? They start Googling. If there is no track record on you doing social media, there's no track record of you having a digital or an online presence, they're going to be like, who is this person? On the flip side, I have seen several people, sometimes they just start following me and I don't know who they are. And then when we have like the deal right now, we get a little further on it, and the one we're in escrowing currently, and seller goes, oh yeah, I watched several of your videos on Instagram. Yeah, I know. So it's like all of a sudden they have been following me, and now I have built a relationship with them. And this is my number one hack for networking events. Stop sharing business cards or blink cards or whatever it is. Connect with them on Instagram first, then give them your number. Make sure that they're following you on the spot. Why? Because if I get your phone number, I'm not going to sit and text you. Did you see my new video? Check this out. Check this out. Oh, I took a photo of me and my cat here. Like, no one cares. But if they're on Instagram anyway and they see you, you build a relationship. Yeah. And that's what's valuable later on. So I stopped sharing. Like now, even when I go to some of these super fancy events, it's like, are you on Instagram? No. Okay. Are you on Facebook? No. Okay. Are you on LinkedIn? Yeah, okay, let's connect there. And then, but can I get your number? Absolutely. Just follow me here first.
100%. Yeah, me and Jesse that's kind of one of the reasons behind this podcast is try to just build a digital presence so that you can actually get your name out there and people can see what you're up to, see what you're doing. It is now, like you said, it's like the resume of today's world.
Graham, you also mentioned too, like when we first started this, I can't remember the exact figure, but it's like in order to like trust somebody or to get to know somebody, you have to listen to them talk for like 7 or 8 hours or something like that. Mm-hmm, what was that stat?
It's something like that. Yeah, 7 hours. And it's like the quickest way you can get somebody to listen to for 7 hours. You know, the sooner the better. Yeah. And a podcast, if you do 7-hour long episodes and somebody listens to you for 7 hours, then generally they're going to start trusting you. Or they'll think maybe, you know, if you're not doing a very good job, they might not like you. But they're going to make a decision on you in 7 hours.
But that's okay. Like, there are people that are just not a culture fit for you. But the loss of not creating a digital profile is worse than creating an honest profile and having a few people reject you. Not everyone will love you. That's okay. Some people will hate you. Great. At least you are who you are.
For sure.
I want to add one more thing on the advice here on how we find the deals. Networking. Like I said networking a little bit, but constantly talking to other people in the space, getting curious of what they're doing. If you're listening to this and you're brand new into commercial real estate, just surround yourself with the right people, local meetups, listen to podcasts. People think, oh, just because you're on a podcast, I can't reach out to you. And I said, no, I answer every single message I get on Instagram. I answer myself. If people reach out to me and say, hey, do you know anyone who's looking for this type of deal? And if I have someone, I'll connect you. Even if I have thousands of connections, I still want to help. And I think that pays back over and over again. Several of our deals right now comes from just being friendly and helping other people.
100%. I couldn't agree more. And there's a guy who we had on our podcast. His name's Rich Summers. He's got a podcast, and he says it on his podcast I listen to quite a bit. And he always says, like, if you're not making the money you want to make, it just means you're not shaking enough hands and you don't know enough people, and enough people don't know who you are. I feel like that's pretty good quote, and that's very true. I wanted to pivot.
He's a super nice guy, by the way. I'm in one of his communities.
Oh, cool. Which one?
Cool.
I'm actually in two. I mean, both the seven-figure, I forgot the name of it, social media, podcasting.
The podcasting one, yeah.
And then there is another one with boutique hotels as well.
Oh, sweet. Okay. Yeah. So we had him on the podcast, and then afterwards he's like, you guys should join our podcasting community. And at the time could not afford it. So we're working towards it. But I think masterminds and communities are huge. And I like
he's a good guy. The guests he has on, he had Dan Martell's social media manager on the other day, and in 1 hour I got more nuggets than I could find online in the last 12 months. Mini promotion for Rich. It's worth the money. He's a nice guy, and he's also a person that actually answers every single time you have a question. Like, he just gives his phone number and like, text me. And I think that speaks a lot about his mindset.
That's so cool. That's awesome. Yeah. Well, I wanted to pivot real quick because I remember specifically when we were talking in person, you were talking about your fund, and you were like, I'm going to start my fund with this person and that person. I know you work with your wife. I know you work with another person. I'm blanking on her name, but you were Brenda. And you were very positive about them and your team. You were like very encouraging and saying this is a phenomenal team and stuff. So I want to talk about, when you're starting out and you wanted to get into commercial real estate, people say it's a team sport. And I agree 100%. How's your team set up, and how do you think people should go, about setting up their team to go find these deals?
I think that so I love this question, and I'm going to do a quick promo for what I also do. I do leadership advisory in addition to being in love in real estate. And I actually help a lot of people that are getting into real estate and trying to figure out how to raise capital. Raising capital is something I'm good at. I've done it for software. I've helped a lot of other people raise capital, and I also invested a lot of myself, but I help people with leadership in general. So I have a little bit of background on how to build teams. I would say there are 3 nuggets you got to do quickly. You got to figure out what your core values are. You got to know who you are yourself first before you build your team. And then do a core value exercise. And again, if you go to my Instagram, there is a free resource you can download of how to figure out your core values. It's in my bio. It's 12 steps to North Star. Do the first 3 steps there. Figure out your own core values. Find other team members that if you have 5 core values, 3 got to overlap, because otherwise you will go like this over time. Understand your personality, what your strengths are. There are many, you can do Myers-Briggs, DISC, whatever personality assessment is out there, Clifton Strength. I don't care which one you do. Do that one, take your core value, and then use ChatGPT, Claude, whatever AI tool you prefer, upload those reports there and say, based on my personality, based on my core values, what am I missing if I were building a team of 3 to 5 people? And AI will analyze this and give you a very accurate, like, if you're a visionary, it's going to say you need an integrator. If you're an integrator, you're going to okay, you can get a lot of things done, but you need someone that actually can see the big vision and scale up. AI is very good at that. So just take those, upload them, and you get a good map back. But you need 1 visionary, you need 1 integrator, and you need 1 person that I call them more the introvert or ambient that just likes to dot all the I's and cross all the T's and just get shit done. If you have those 3 people, you have a good start. That's personality. From a skill set perspective, 1 operational person, absolutely, that likes to talk to people, likes to improve processes and so on. So a process-centric person, that's more usually the integrator, but it doesn't have to be. And then you need someone that is really good at cap racing. Someone is a social butterfly and that walks into a room and everyone's like, hi, how are you doing? Like that type of person, even if they're not a good cap racer yet, they're really good at creating the first touch point. And then one of you has to be a good cap racer and go in and lead with credibility, authority, emotional appeal, like ethos, pathos, logos, if you're Greek language. But it's basically emotional rhetoric, logical, authoritative, and emotional reasoning. But it doesn't have to be the social butterfly. They can find them, get in the networks, and then someone else's pitches them. If you do all of that, I would say you're off to a pretty good start. I meet a lot of people who just, hey, I will just like my buddy here and we're going to do this together. And they are not complementing one another. I've never started a business before. That group will do one deal they will suffer for 5 or 3 to 7 years, and they will never work together again. So please, please, please think before you structure your team.
That's awesome. Me and Graham were smiling there when you said vision and then integrator, because I know exactly what you're talking about. EOS. We talk about this all the
Traction.
time. Yeah, Traction is an awesome book. If you guys haven't read it, go get it like today. Like, it's an awesome book.
I read that book. I implemented it in my last company, and it was transformational. There are many other frameworks out there, but that one, just from a mindset, and I would say either Traction or read Rocket Fuel. If you're building a team, read Rocket Fuel first, because it talks about the dynamics between an integrator and a visionary, and what are the things that both of them dislike doing. If you know, if you're a visionary and integrator, if you have your core value set and you understand your personality, your strength, dump all of that into AI and have it suggest, like, who do I need to partner with?
That's a good
Or
idea.
ping me and I'll help you as well.
Yeah, that's awesome.
That's great. Because Jesse, me and Jesse both think that we're both have a visionary aspect for sure, but Jesse, from what we understand, it seems to be more like the integrator, and then I'm more like the visionary, and we complement each other pretty well in this stuff.
For sure.
So it's good to hear that. I'm curious, which one? I assume you're the visionary, and you said you do a lot of the capital raising. So is that kind of the role you fall into?
I'm the visionary. That is also, I'm an exceptionally good integrator in one iteration, and then I'm bored out of my mind. So that's basically the definition of a visionary. But I can do integrator work. My role is, absolutely cap raising. I also am in a lot of networks. So I actually got Brenda and me spiraled into a lot of them. And we are raising, like, there's some big checks in there as well. We're working on some of that, trying to raise a larger check so we can go get a whole portfolio all in one. So a larger check for me is anything north of $15-20 million. Then then my wife, she is absolutely hardcore integrator, operations, process. She gets happy when, like, everyone have signed the legal document, and now I get to review it with the lawyer, and like, woo, bookkeeping, finance, and I'm bored out of my mind. So that's her. Brenda is also a cap raiser. I would say what I also add with my business background is a lot of marketing and business strategy. And then the people we partnered with is Erica and Jason Bates, and they are more asset management. And Erica is asset management. She is a hardcore project manager, and then also very commercially focused. And then Jason, he's the deal maker. He's also very active in Sub2. But Jason is absolutely the deal maker, really relationship, customer experience. That's his forte. What I'm sitting and working on right now, and that's another quick hack, like, do not wait to build a marketing plan or your expansion plans until you close. Like, no, you got to front load the marketing plan and the awareness building around whatever you are acquiring, ideally 45, 50 days before you close, because you don't want to spend 30 to 40 days building a plan when you just acquired it, and then you have everything happening at once. Plus, by doing the marketing and the business strategy up front, you actually de-risk a lot of the things during the first phase of the closing. I'm blanking on the name right now. Due diligence, during the due diligence. So I see so many people waiting with that. Don't wait with that.
No, that's all such good information. I feel like having a strong team is one of the best ways to grow a portfolio and be successful. It's not really a solo sport, and you're probably going to get burnt out. You're going to get discouraged. Yeah. So having, people you can work with and depend on is huge. I have a question. You don't have to go into specific details of this, but for people who want to go into the fundraising route where they're raising money for deals and going out there and, either syndicating or doing a fund, how do you structure that? We've had a lot of people on here. I know a lot of LP GP splits are like 20-80. 70-30. How do you guys, or generally, how are you structuring your deals? Do you have prefs? Like, how do you recommend somebody structure a deal like that?
Most of the avatars or personas that we raise capital from, they have an engineering background or they are very business savvy. The more complicated you make it, the harder it is to do the sale. The more they want to open up and build their own spreadsheet, the harder it is. So we try to keep it very plain simple. We have targeted returns, which is 25 to 30% IRR for RV parks, 15 to 19% cash on cash, but we want to push 20 if we can, 2.5 multiple to 3. That's our target. If we can make the deal happen that way with a 70-30 straight split, no waterfalls, no cliffs, no prefs, we will. If we cannot make the numbers work, but hit that target range, then we start introducing pref. We start moving the slider between the LPGP split. But that's the target range at a 70-30. I rather say no to 10 deals or 20 or 100 or 300. I don't care. In the end of the day, you need deals that are really good because you're going to get stuck with that one for 3 to 7 years. And you don't want to be like, I'll make it work. Like, no, big red flag, walk away. You need to really be excited about it. So that's why I don't like to move the needle on this one. Like, no, it's a 70-30. Have we had people come in and say, I'll drop $500,000, I drop $1 million, but I need a better split? Absolutely, it happens. But we haven't, so far on this new JV, we haven't been able to, or we haven't had to use it even. So we're that's the goal. Now, one thing in terms of, because we're doing, sometimes we have to pay finder's fees, another thing. So our acquisition management fee tend to get a little higher. Again, there's no bank debt, but someone have found the deal for us. Or we can also maneuver around the management fee or the financial fees and all of those. But we try to keep them around 2%. And the acquisition fees typically will sit 4 to 5%, depending on how much we have to pay someone else. And then what else do we do? On the one we're racing for right now, we did actually introduce an 8% pref on that one. This deal already cash flows at 6% when we're buying it, but we still introduced an 8% pref because it's the first JV together between these two funds. And we wanted to tell the investors, look, we'll pay you first. It's a small gap to close where we're at today and where we need to go. And that made a lot of people go like, okay, I'm in because the risk is so low.
Yeah, I'm always curious how people structure their deals because there's just so many different ways. But I like that you said, you try to keep it as simple as possible because a lot of times if you get too overcomplicated and start going into all these different numbers, the average person who's not in real estate all day long, every day looking at deals is going to be like, I'm confused. And I'm going through the book now. I'm sure you've read it, Building a Story Brand, but it says, if you confuse, you lose. Yeah, I think that's great.
And always think of the person you're talking to. Like, what do they like? I interviewed a bunch of them early last year. How would you like? What do you prefer? What have you invested in today? What's your split in how much single family, multifamily, other commercial classes? Okay, what are your expected returns? And what I realized is you sometimes create a narrative in your own head that they don't give a shit about. Like, instead, focus on what they truly care about, your investors, and give them that. Don't overcomplicate it. But what I will add, at least with what I've noticed now with RV parks, because it's a new investment class for several of the people I have in my network, a lot of them are in commercial real estate. But in RV parks, they are a little bit more hesitant early on. So they want to see better returns. And that's why it's a harder sale unless the IRR is plus 25. That's the advice I could give. In other deals, they would be okay with 20 or even below. But in this case, it's new, unproven. There are some changes in the market. Just give them that then and then walk away. Like, never move the goalpost. If you have a deal that is outside of that, walk away. You don't want to buy yourself another W-2. Take it from the guy who's been in the W-2 world for a long time. I'm happy now. I don't want to go back to having another W-2.
Yeah, no, that's great advice. And it kind of segues into one of the last questions I had, which is, do you think RV parks, they're new and it's kind of a new territory. Do you think it's a good play for somebody who's brand new to go out and try to find a smaller RV park, maybe like 30 pads or less or something like that? Do you think it's a good asset class to get started in? And why?
And I'm not saying this to discourage anyone. I would say join an existing team that have operated businesses before. Mm-hmm. If you have run a business where you have had up to 20 employees yourself and you have been, the ins and outs of, and you're entrepreneurial, go after RV parks yourself, build a team. If you haven't run a business and been a manager and entrepreneur before, join another team and learn from them. An RV park is not a real estate thing. It is a business you're buying, and the marketing, the sales, everything else is a business, a service, a product. It's not an asset you just buy and hold.
No, that's a great point. And it seems to be a trend. Not a trend, but like a good trend that people now, you hear about Cody Sanchez and Pace Morby and all these people, they're talking about boutique hotels. They're talking about RV parks. They're talking about storage. And a lot of these things, like you said, they're kind of much further on the side of commercial real estate that is more like a business than just a pure real estate investment. Now, can you get a much larger return, higher cash flow and all that stuff? Yes. But it's similar to like Airbnb, where it's almost like another job. You're going to get a lot of cash flow from it, but there's so much, it's so heavy on the operations that, it's challenging. So if you're into more of the passive stuff, invest in more traditional commercial real estate. Maybe if you have a business sense, like Andre says, and you've run a business before and you're entrepreneurial, then this could be a great avenue for you to go out and buy RV parks, or maybe it's a boutique hotel and you're willing to put in more time and more effort and more management for that higher return and higher risk.
1,000%. In the end of the day, a business is a leadership business, marketing, sales. It's not what studs are in the wall or finding the studs or painting something. Like it's not putting makeup on the pig like it is in traditional real estate. And if you screw it up, you can always reach out to me and I'll help you with leadership.
Yeah, for sure. Awesome. Jesse, do you have any?
Sorry, I couldn't help myself.
No, you're good. You're good. Jesse, do you have any questions?
I did have one more question. You mentioned it a little bit earlier and kind of like passing, but everybody talks about like, oh yeah, I want to buy bigger deals. I want to buy, portfolios maybe. But you mentioned that you bought a smaller deal that was just such a good deal you couldn't pass it up. Are you seeing that these smaller deals are more liquid versus the bigger deals?
I would say when you get into, that's a great question. I would say when what I've seen in the underwriting, when the deals are going north of 5 million, 5 to 8, they usually, for some reason, they don't cash flow when we buy them, have expectations on a price that is much higher for some reason. I don't know why. It's because maybe it's operators that aren't the moms and the pops anymore, and they aren't as interested in seller financing. What I've noticed, if you are, with that said, like if you are, like I said, 5 million and above, there is a pocket there, 5 to 8 million, and there are exceptions to this. But I'm just saying that below 5 million, you will see a lot more creativity and the moms and the pops and the boomers and all of those things I already mentioned. No, I haven't. That's the only pattern I have seen. And when you get over the 12, 15 million, they're operating like a proper business. And now you're buying them at just a cap multiple, basically, or cap rate multiple. And they usually know what they have. With that said, we do stumble on some really mismanaged where leaders fell out of love. They don't love what they do anymore. They have competing things, other businesses. We find those as well, but we don't have any of those under contract. The existing deal, why it's phenomenal, is just because there is no bank debt. It's all seller finance. It's very low single digit interest only for a long time frame without going into specifics. And if you have such a deal and those terms, you will always make it work in the long run. The risk to entry is so low. There is still risk, but it's so low compared to if you have to spend 12 to 18 months building something and then you cash flow.
No, yeah, that makes a lot of sense. Jesse asked that question. I know he did because one of the owners of our firm is he's an awesome commercial real estate investor and a beast in the space. And he told us that, there's nothing wrong with deals that are like under $1 million, the smaller deals, because there's so many more buyers for them. They're so much more liquid. So like if you get a $5 million deal, and let's say for heaven forbid you get into trouble or something, you need to sell it, it's not nearly as liquid. There's not as many buyers out there. But if you get a $500,000 deal and you need to sell it, there's a bazillion buyers out there because that's a smaller price point. So I think that's probably where that question came from. I think that's a great point.
That's exactly right. Yeah.
Thank you for clarifying that one. I didn't see that. Now I will add that to my pitch whenever I do smaller deals going forward.
Yeah, I think it's great. And two, also, I've seen them do it time and time again, and I've seen other people do it. You can create a lot of value on a little deal. Like you can take a $500,000 deal and make $500,000 of value on that deal. So it's like you don't need $1 million deal to make a big value add play. It can be a smaller deal and it can be tremendous value they add, like hundreds of thousands of dollars. So I think that's definitely something people should hear. But man, this has been a great conversation. I've learned a lot personally. I took down a lot of notes that I'm going to go back and review and probably ask you some more questions about offline, but thank you so much. Thank you so much for coming on. And if people do want to connect, maybe they want to invest in your into your fund, or they want to do a coaching call with you in business, what's the best place for them to connect? I assume you're going to say Instagram.
Instagram, Andreas the CEO. They can also, I have a website, leadersadapt.com. People can go there. But Instagram is absolutely the best. Usually my response time is 24 to 48 hours. And I have no problem. Like if I can't help you, I'll connect you with someone that can help you. At this stage of the game and in my life, I care more about helping rather than the actual numbers for myself. But with that said, obviously I don't work for free. So if someone is abusing it, I will push back.
Yeah, no, absolutely. And that's completely understandable. Well, thank you guys so much for listening. Hopefully you got a lot of value out of this, and go follow Andres on Instagram. If you're not following us, go follow us on Instagram. That's right. Also, if you wouldn't mind, if you've been listening to us for a while, go ahead and give us a review, whether it's Apple Music or Spotify. Go ahead and give us a review. We want to hear your feedback, and we appreciate it. So thank you so much.